I think Patrik, André, and Sadeq are known to most of you here. Well, as you just heard, I'm a journalist and an author, and about a decade ago, I sat down and wrote a book about the rise and fall of Japan. And before I did, I thought I've got to study a fabulous business book that I really admire so that I have something to emulate. And the book I chose back then was Roger Lowenstein's account of long-term capital management when genius failed. Now, some of you might dispute some of the accuracy of that book, not looking at anyone in particular, but it is a fabulous account of hedge funds. And one of the reasons I chose it back then is because if you go back 10, 15 years, hedge funds for a journalist were one of the most thrilling, sexy things you could write about in finance of all. In some ways they were a bit like sort of James Bond and Dr. No rolled into one as far as the financial world was concerned, something that would always grab attention. Now, what's fascinating about the last 5 years of writing about finance as a journalist is that hedge funds have actually not been centre stage of the financial plot. They weren't the institutions that blew up the world back in 2007 or 2008. That was good old boring banks trading boring AAA products and things like subprime mortgages. They weren't at the centre stage of many of the scandals, and they haven't been terrorising regulators recently in Europe. That's down to good old boring Cypriot banks and French banks and things like that. And even from a journalist perspective, if you're looking for stories about high earnings, dramatic high rolling funds, etc. like that, often it's the commodity trading houses which are generating more excitement in journalistic terms these days than hedge funds. And that, of course, reflects a bigger shift, which is that hedge funds used to be infamous or famous for producing stellar returns. In fact, if you look at the returns coming out of the hedge fund sector in the last few years, they have been remarkably unstellar in many ways. So that, to my mind, raises a question. Is it good to be boring? Is it good to be becoming more mainstream? What is going to happen to a hedge fund world if they can no longer have these dramatic, high-rolling gambles that produce such wonderfully storylines and profits and all the rest of it? If hedge funds are going instead into areas like lending to small, mid-cap companies, things like that, which certainly are in the US these days, what's that going to mean for the industry as a whole? In a world where leverage is going out of fashion, can funds make money if they're not super leveraged anymore? What's going to happen to their investor base if increasingly we're seeing not so much wealthy individuals supporting hedge funds, but more institutional, even government entities instead? Can the sector keep growing? All big questions which we have a fabulous panel here to discuss. So I'd like to start by asking each of you to reflect for 5 minutes or so about where you see the hedge fund industry going in the next few years. Whether you think it's going to go back to being the James Bond and Dr. No rolled into one, or whether it's going to remain truly boring. Where you see, if you'd like to address the question, where you see some of the big opportunities going forward, and perhaps what some of the big pitfalls are as well. And I don't know who would like to start first. We're going to have each of you commenting for 5 minutes, and then I'll ask a few questions, and then open it up to wider debate. But maybe Patrik, since you've had the joy of sitting closest to me. You'd like to start.
Thank you. Well, I mean, I guess I don't think you can look at hedge funds in isolation. I mean, I think that, it's very much a changing financial landscape, or the landscape of markets in general is changing, and that means that the role of alternative pools of capital is also changing. And I think that if you take a step back, let's not spend time on sort of all the thousands of funds that start and sort of don't really produce what they say they will, and I think that the regulatory hurdles, the costs of running the business, all of that makes it the barriers to entry and let's call it the ongoing barriers to survival has definitely reduced sort of the scale and the scope of the overall field. More importantly, I would say that the long term, I believe that there are three kind of reasons for being as an alternative, whether it's a hedge fund, a private equity fund, or whatever it is. One, either you provide a solid alpha, that relative to the fee structure that you charge, you are able to kind of produce additional value for your investors. Two, that you provide access to asset classes or to strategies that most people cannot access themselves. So let's take deep distressed investing. Obviously very old asset class, people have been doing it for a very long time, but it seems to produce decent returns through the cycle. And I would argue that it's very much because there are barriers to entry, it's hard for people to kind of flood it, and it's sort of something that people want in their portfolios. And three, which I think is the way that many people cheated and many strategies are predicated upon, is simply leverage. So if you're looking at strategies that were sort of highly leveraged relative value strategies, you're looking at sort of some estimates, many thousands of long-short equity funds, and either with a healthy dose of beta or through leverage or both, seemingly outperformed sort of some kind of reasonable benchmark, I think that whole business model is under challenge. So at some level, I think that you have to take a step back and say, what are the areas that the banks are no longer playing in or can't play in? What's happening to other pools of capital? And what are the legitimate sort of reasons for being as a hedge fund or any other kind of alternative pool of capital? And I would argue that for this business, it's actually one of the most, and especially if you have a little bit of a sort of finance kind of theory background, that it's one of the most dynamic and one of the most interesting times for the industry that's ever been. Because it's not about leverage, it's about actually providing sort of real services or providing access to new investors to strategies or in particular asset classes that they haven't been able to access before. So I'll probably stop there, but basically I think that it's back to basics. Leverage is not a way of kind of creating artificial impression of our performance and alpha, but you actually need to demonstrate either access or real alpha.
So there is life after leverage.
Oh, absolutely.
Right. What kind of returns, before I turn to André, what kind of returns, though, do you think that are reasonable to expect in life after leverage for the hedge funds, if you're looking at strategy 1 and 2 out of those 3 strategies and knocking out the third one?
Well, I think that, if you knock out leverage, so some strategies hardly work. I think that if you're looking at sort of the macro universe, I think that in a world where interest rates are close to zero and sort of a lot of the obvious carry trades produce very little, I think that life is tough. I mean, it's probably the Japanese kind of equity market and the dollar-yen trade, sort of simplified, was able to breathe some life into a sector that's been sort of challenged for a while. I think long-short equity, especially in light of kind of stricter enforcement and let's call it just information gathering, I think that that's an area that's going to be a lot tougher. On the other hand, I think that what the banks are either voluntarily or being forced to withdraw from, whether it is non-agency, non-conforming mortgage product, SME lending, mezz lending, I think that there is sort of a whole brave new world where new people kind of need to plug the holes. And some of it will be in maybe REIT form, BCDs, but it will also be hedge funds and private equity structures.
Right. I somehow can't imagine anyone writing a thriller book about a hedge fund doing SME lending in quite the style as When Genius Failed, but there we go.
What I'd like to say is a little bit about what I think the structure of the industry will look like in the future, or what I think it will look like rather than a definitive statement, and what the fee structure will look like. In my opinion, hedge funds or alternative investment management businesses, if you want to call it that, with or without leverage, were and possibly are designed to generate what alpha they can find. If André loves doing what he does, then the probability that he will generate alpha is probably higher than someone else. So I think the structure of the industry looks more and more embedded within the asset management industry. And one would imagine that the asset management industry, which today charges fees for providing much not much more than straightforward beta, ought to, if markets are efficient, evolve into something that produces mostly index-type products, ETFs and index funds. And then there should be an alternative investment management business which is designed to produce alpha. Now, this might just be a dream, but an investor can then effectively, through a combination of those two products, create virtually any risk-return profile that he wishes to create. Now, over time, I would imagine that that's the way things will go. It takes a long time for these things to evolve. There are a whole bunch of incentives which militate against this kind of stuff. You know, the consultant industry, for example, being one of them. And also a rush to safety amongst fund managers who provide those services for life insurance companies and pension funds. So that's one structural thing which I see evolving over time. The second thing is the fee structure. I think the hedge fund fee structure, which is essentially what I call an annual reset call option for the hedge fund manager, that really does need to change, because what they've done is they've created a fee structure which then forces them to produce other things to correct for the deficiencies in the fee structure, things like high water marks. I mean, I cannot imagine anything much worse than a high water mark, because when you do have volatility in the markets and performance deteriorates, and at least for a few years after that, there is no incentive for the hedge fund manager to do anything. And it's not what you want to do. And people don't understand. You drop 50%. In order to get it back up to 100, you need to make 100%. So it takes an awful long time to get back there. So what kind of a fee structure will work? My view is that by hook or by crook, the private equity fund business has come up with a slightly better structure than the hedge fund world. What I mean by that is that the private equity fund world essentially pays out on a fund as a whole business, as it's called. Cash in, cash out. When you put money in and when you take money out, that's when you pay your fees. I'm not saying that's entirely appropriate for hedge funds, but more and more, I think there will be a strong push from the investor community to ensure that fees meet real performance, not annual reset mark-to-market call options. And that will require, I think, a structural change within the hedge fund business as well, where, due to what happened with Lehman Brothers and the prime brokerage businesses, a lot of investors don't want their assets necessarily pooled. When you have pooled assets, then you have to fix that by having gating. And what normally happens is there's a rush to the door, because every hedge fund or alternative investment management business has liquid and illiquid products. And the way gating works is that illiquids get stuck, the liquids get sold, and the guys rush to the gate because they know that's happening. One way around it, and many investors have discovered that, is to have effectively something that looks like a managed account. And then they find, and at Nomura Lehman Brothers, when I took over Lehman Brothers and managed it, one of the new prime brokerage businesses we were setting up was essentially to provide investors with this kind of a compartmentalized account. And that effectively also stops the whole gating problem, because they've got their own business. Now, there are issues on how to manage it, the legals, how it gets sort of worked under a bankruptcy. So these are the things that I think the hedge fund industry will have to tackle. Overall structure, fee structure, and compartmentalization. And if it manages to tackle those things properly, there's a real future for the business.
Well, thank you, Sadeq. That's absolutely fascinating. And I should congratulate you, because you are the first person I've ever had from the financial industry who sat on the stage who has voluntarily raised the issue of hedge fund fees, other than someone who's actually a hedge fund client. Normally I have to drag it out of hedge fund officials or financial people to start talking about it. But can I ask, before I ask both André and Patrik what they think about this fee issue and the structural issue, do you think 2 and 20 is dead? Because in many ways that has been one of the defining features of the hedge fund world in the past.
Well, nothing's dead. I mean, you could have 1 in 50. And some people may accept it depending on what they think the performance of that hedge fund looks like. But is it being questioned? Definitely. However, the structure, i.e. a fixed fee based on assets, or even a fixed fee based on dollar values, and a performance fee are absolutely critical. Now, the 20%, what should it be based on, is a bigger question. Historically, it's been based on the total return on the fund, which doesn't distinguish between alpha and beta. It doesn't even distinguish between how much leverage you took, and you were encouraged to take more leverage because of the annual reset call option. So you just took more. Now, I think what needs to happen is that you've got to get rid of the beta. And the way people have historically gotten rid of beta is by having some kind, in private equity funds anyway, some kind of a hurdle rate. So they say, okay, well, if you perform better than 6%, which is some number, 8%, we can pay you a fee over and above that. But then there's always been a catch-up, so that after a certain point, you can pay fees on the entirety of it. At Metage, once upon a time, we used to run a fund that was a long-only emerging markets equity fund. But while the investor was exposed to emerging markets equities, Metage got paid on the basis of the outperformance of the fund against the MSCI emerging. Now, I think that is a much better structure, and I think more and more you're going to find hedge funds and other alternative investment schemes being paid on the basis of generating alpha against measurable. Now, whether that's 20% or 50% or 10% is a negotiable quantity. And I imagine that the percentages will rise if they have to do more, if they can be more closely identified with alpha.
Right.
Long answer, sorry.
No, it's fascinating. Well, okay, André and Patrik, which of you would like to comment on fees first?
Well, I mean, I sort of agree with both André and Sadeq that I think that it's very much like everything else, supply and demand. If you have sort of very high alpha and you are to the limited capacity, you can charge very high fees. If there's something that's very scalable and you can deploy the capital, then you're going to be sort of faced with that trade-off between fees versus scale. So I think that all of that is happening. There's no question that given the flows into many of the end investors into the hedge fund and private equity industry has changed. It means that the balance of power between them, sort of the different sizes of capacity, has changed. But I think that there's a much more interesting question, because that's obvious. That's just sort of supply demand, and if you don't generate, the returns, people are not going to pay the fees. I think the more interesting question is liquidity, and I think that it's a very bifurcated way of looking at the world right now, where you have a tremendous emphasis on liquidity in the so-called hedge fund space. And a lot of the pools of capital that are being allocated into the hedge fund industry are looking at 90-day liquidity or sort of 30-day liquidity, what have you. And then you have at the other end, you have private equity, where you're looking at years of kind of investment horizon and then maybe a decade of kind of harvesting. And I would argue that a big part of the biggest and sort of most scalable opportunities right now are actually in between, because those were areas where the banks used to play and using kind of their funding advantage to be able to kind of generate sort of relatively high investment returns. So in a way, I would argue that the industry is a little bit antiquated by looking at, on one hand, hedge funds and on the other hand, private equity funds. And really, both from whether you're sitting at an insurance company, an endowment, pension fund, what have you, you really should have much more of a continuum of liquidity and return expectations. And it's a little bit, I mean, all of those things happen, but they happen very slowly and they react very slowly. And I think right now, the PE world is very much benefiting from sort of having established itself as a big kind of part of any large long-term portfolio. And in the meantime, especially with interest rates being extremely low, with the exception of a number of what I would call limited, not so scalable strategies, high frequency being one of them, where you can, with very, very good liquidity, generate very high returns. But there is this whole swath in the middle where really, in order to run the risk in a prudent way, you need to have a different liquidity structure than many of the traditional hedge funds had. And if anything, I would argue that it was when returns were starting to come under pressure, many hedge funds, without having changed their liquidity provisions, started to go downstream. They started to invest in more and more assets that really were only liquid at the peak of the market. And then when the music stopped, you had a problem. Whereas I would argue in many cases there was nothing wrong with the investments. It was really just that you didn't have the staying power and the ability to kind of ride out the cycles from a market-to-market pricing standpoint.
That's fascinating. Sadeq, I saw you were scribbling curiously. Were you wanting to?
You caught me. I was just
I'm
trying
a
to figure out
journalist.
what I'd eat for lunch.
Okay, well, if you want to comment, that's great. If not,
No,
I won't.
I'll give you a quick comment on liquidity. I think you're right, Patrik, but I think the market provides, through a variety of different hedge fund styles, the gamut, from very illiquid products to very liquid products. And so long as there's transparency, and so long as there isn't a unilateral style change, if you want to call it that, then I don't see that liquidity is a characteristic that you've got to say is uniform for every product within the hedge fund industry. It really depends on what the investor's needs are. The point is clarity, transparency, and letting the investor make the decision. And if it's part of a portfolio which says you've got this set of products which are alternatives with this sort of alpha-generating characteristics, set of alpha-generating characteristics, and by the way, a significant amount of this alpha comes from the lack of liquidity, there's a price for that. And then the investor can make a decision what proportion of his or her portfolio is invested in the index product for diversification benefits, etc., and what linear or nonlinear combination of his overall of that is in the hedge product. And I think that's what ultimately is going to be the key to how this industry evolves over time.
Right. I'm going to turn it over to questions in a few minutes from the audience, because I'm very conscious that we have a lot of brain power sitting in the room that probably can ask some fabulous questions. But before I do that, I want to ask each of you where you see the big opportunities coming up for investing, given this very strange, distorted macroeconomic landscape. I mean, a friend of mine who's a trader recently sent me a wonderful joke or cartoon with one of those old-fashioned posters they used to put up inside high schools or senior schools, secondary schools, as part of an anti-drug campaign. And you had a sort of scary figure with a great big slogan saying in capital letters, "Just say no to drugs," under which someone on a trading floor has scribbled, "unless they're the really good sort from the government." Which sums up where we are financially right now. We have a financial system which is completely addicted to easy money in a spectacular way. So how long do you expect this addiction to QE, to central bank money, to continue? And where on earth do you expect to find returns if indeed it does continue? Or are you sitting there hoping for massive volatility if and when the Fed ever actually starts to taper?
Well, I guess I would go a little bit further and claim that the real economy is on drugs. Because, it's only because of the financial levers that the central banks, it's sort of, whenever we discuss the crisis or, what's happening with QE, whatever, it's always talking about the financial world. But actually, it's all about the real world. Who are the incentives on the ground if you're looking at, mortgage origination, or why are the central banks pushing so much sort of money through the system right now? And I would argue that we're going through kind of a period where organic growth due to pure, let's call it productivity growth and technological change is relatively slow. To me, it feels like you're back to the 70s, and we are basically creating this artificial wealth effect to kind of push demand in a world where basically supply is unconstrained and demand has for a long time been on sort of fake respiratory support from leverage. And I think you could argue that change happened not 2007 or 2008, but it happened more like 2003, 2004, when that kind of decade-long productivity spurt that came out of the whole, what I would call the reaping the full benefits of the information technology, seemed to have tapered off. We just didn't notice it. Greenspan didn't notice it because he was disguised behind globalization, lack of inflation, and leverage that seemingly supported it. But to me, it's just that you kind of have a wealth effect that drives demand, and you don't have any obvious inflationary pressures because of because of globalization and all the other things.
So we're all super duper addicted, even more addicted than I suggested. So
Absolutely.
what does that mean? Where do you find opportunity within a super addicted world?
Well, I think that the opportunity, that's a little bit different, but I think it just highlights that it's a very difficult balancing act to withdraw these drugs. I mean, to do that in a way that doesn't wreak havoc on the system. I mean, if you start to see long-term interest rates rise sharply, I mean, we know that this whole thing falls apart. So I think that everyone is a little bit in a bind, and I think it's a pretty dangerous situation. From a trading standpoint, from an investing standpoint, I'm sort of back to basics, that you basically have to look at the areas where you have relatively little capital relative to the scale of the investment opportunity. And a lot of that comes from regulatory changes, at least in the space that I'm looking at.
Sadeq, what did you study?
I studied economics and then finance at someone was one of my tutors, hence he knows about my motorbike riding fancies.
Right.
My daughter is studying anthropology, and I must tell you, some of the debates we have over the dinner table, she's at university, are fascinating, because she does come at it with a slightly different take. And I find them fascinating. The way she approaches things quite interesting.
It's a very different cultural and mental
Absolutely.
filter.
And I think
anytime
it's
hedge funds
brilliant.
start hiring anthropologists, I know the world really has changed. But anyway.
May I comment a little bit on what you brought up, which is the opportunity set?
Yeah.
Well, in reality, I don't think the opportunity set is either wider or narrower than it has been before the crisis. Possibly the balance is, from a risk point of view or the leverageability point of view, different, but the opportunity set is really not that different. And the kinds of technology people use to figure out whether a trade is a good trade or a bad trade remains approximately the same. The parameters they're using and the models they're using are a little bit more sophisticated. The one thing that I think has really changed from 2008 till today is the impact of the policymaker or the regulator, and the anticipation of what that community of market participants, and they are market participants today with QE and everything, probably the biggest market participants in the liquid debt product and foreign exchange product, what their behavior is going to look like, and predicting their behavior, not just in the way, in how they will regulate you, not just from a process point of view, but also capital allocation and other things point of view, but also the actions they will take in their quest to make sure that the economy as a whole moves along a less volatile path. I think that is something that I don't know exactly. I can make some guesses at, but I think just to put in a pitch for what this conference is based on is this policy unit that MIT is trying to develop, and I think a lot of thinking in there will have to do with the endogeneity of regulation, and so when a regulator or a policymaker makes a statement, it is interpreted, reacted to, and then his future move is thought about, and the markets and the participants react to all of that. And the regulator has to understand that. And my view is that the regulator does not. Most regulators think of their policies.
I don't think they think.
Okay, well, I wasn't going to go there. Most regulators think that this is a single move world. You make a move, or you make a law, and everybody will basically adhere to it. In reality, it's a lot more complicated than that, and I think they need to kind of get it. And I think a policy unit at a place like MIT, which is absolutely solidly based on financial theory, would be a huge help for them to go to if they choose to do so.
Yes.
But I think that's the big issue going forward. It's how the policymakers and regulators will try to tweak things.
Well, I must say that's an area where I think sociology and anthropology and psychology absolutely start to play into economics and finance. And for me personally, as an anthropologist, I'm very firmly convinced that what I call the 3 C's are going to be crucial. Credit, in the old-fashioned sense of trust, cohesion in the question of whether societies are sticking together or not, and complexity. And that's driving a lot of regulatory interaction with finance right now and the wider political economy. Well, just before I quickly go to questions, I mean, I don't know whether any of you in the audience have read, or on the panel, Lee Smolin's book. He's a respected physicist who's done some fascinating work looking at the application of physics to finance and economics, but looking at the application of modern cutting-edge physics to finance and economics. And this question of reflexivity and change is something which people are beginning to realise can be very important to take on board if that Newtonian physics vision of how finance is supposed to work no longer operates in this new world. But anyway, I see some...
Before we go on, I guess I would take exception to the idea that the world sort of pre-crisis was sort of a physicist or mathematician's world. I think that the first thing you learn as a junior trader is human psychology, and that ultimately, whether it's managing a market-making book or trading a proprietary book or a large portfolio, if you don't understand market sentiment and sort of how, whether there are sunspots or kind of the popular sentiment is sort of moving, you tend to get into trouble pretty quickly. And yes. So, and I think that those lessons were learned, I mean, at least a decade before this financial crisis. And I think that, you know, and I would argue that the main thing coming into sort of a PhD at MIT, thinking that I had a decent math background, I think that the first thing you learned the hard way was that very little interesting economic and interesting finance came out of pure math. It really is about understanding the psychology, the game theory, and sort of the whole economic overlay. And I think that that's one of the main, I mean, there are areas like option pricing, obviously, where it's a little bit different. But in most areas, models in economics, in my humble opinion, are about illustrating phenomena. They're not about predicting sort of entire macro systems. And I think that that's where some people go wrong, and also people's perception of what's really going on in, whether it's in a trading institution, hedge fund, or what have you. It's, you know, most people, I think, who are good at it realize pretty early that there is this other dimension.
Yes, well, Andrew Lowe has certainly done some very interesting work on that front as well. So now I could see some hands waving even before I finished. Has anyone got any questions they'd like to ask? Okay, over there. And it would be courteous but not compulsory to identify yourself.
My name is Philippe van Overberg. I work as an investment consultant, and in the hedge fund industry, so I can perhaps share a few insights. What I've seen over the past 7 years is that the industry has become increasingly institutionalized. And what that means in English is that high net worth individuals have become less of a force, and you'll know this very well. Pension funds in particular are the rising tide in that. And what I've seen as a result, and these things go together, is that there's been a transition from an objective of absolute return to one of risk-adjusted return. And I think, you know, one of you, perhaps it was Gillian, spoke about dumbing down of the industry. That may be another way of saying it, but it's not so much a question of shooting the ball or hitting the ball out of the ballpark, but really more of portfolio management and risk management. I think that's certainly a big legacy post-2008, broadly speaking. As a result of that, again, my observation, coming back to the topic of fees, my contention is that you will see increasing pressure on fees as the industry continues to institutionalize. And again, maybe it may not affect the three of you equally because you deal in very different strategies. And then the other thing I wanted to say is, and this is to Patrik's point, which I thought was very interesting and spot on. You spoke, Patrik, about a continuum in terms of sort of liquidity between hedge funds and private equity. And I have been seeing that. I totally agree with you. So there's a number of funds that have been raised in the market recently, in particular, to invest in the European distressed opportunity, which are really smack in the middle. They're hybrid. So these tend to be lock-up vehicles. So in that sense, less liquid, more private equity-like, but they have features which enhance the liquidity in the sense that they monetize more quickly, or in some cases they even pay yield. So I think that's absolutely correct, and obviously there will be people who are bright and who can put together and structure these products because there is a demand for them.
Thank you. Well, I think that's probably more of a comment than a question. So does anyone else have any more comments or questions in the audience? Stunned silence over here.
I was told to stand up. I'm Paul Pillors. I'm interested in sort of the mechanics of the business, and particularly in how someone who's running a large and diversified hedge fund thinks about managing change in investment opportunities. And as, for example, I think broadly there's different kinds of trading strategies, and there's different products that those strategies can be applied to. But the strategies and the products change, and the trades that made money for us in 1995 are no longer the trades that make money for us. The products that we understood in 2007 are no longer the products that we understand. And when you end up as a relatively focused fund, how do you manage your product offering and your traders to make sure you're moving from one segment to another?
Would any of you like to address that?
Well,
Patrik?
I mean, I can take a stab at it. I mean, I don't think that there are any sort of easy answers there, because it's largely defined by what your flexibility is in the current fund structure. So if you are in a multi-strat structure where you effectively are allowed to do whatever you want, you have clearly, or not whatever you want, but you have a lot of flexibility in moving capital, de-emphasizing strategy, building new strategies, and I would argue that your ability to adapt from that standpoint is extremely high. I would argue, though, however, that the number of funds that have those very broad mandates is shrinking. And the track record for sort of very broad-based multi-strat funds has shrunk over time. So I think that the name of the game going forward, and sort of the previous sort of question or comments, I think he would probably agree with this, that more and more the investors want to decide what their money goes to. So the idea that, hey, you're a smart guy, take my money and figure stuff out, that just doesn't work anymore. And that in most cases, especially the large institutional pools of capital, will say, you're a high frequency guy, you do this, we think that it's reasonable with this and these sort of liquidity conditions, and this is exactly what you're supposed to do. And anything else, you have to come and talk to me first. And similarly, you can go through the whole spectrum. So I would say that the themes, from my standpoint, is that you have to convince investors that when you have a new idea, that you are the right person to execute it. And that the power has definitely shifted from being the smart guy, trust me and I'll sort of take care of it, to I know, how I want to build my portfolio, whether I'm a sovereign wealth fund, national pension fund, what have you, endowment, and I want to be in control how I move those buckets around. So I'm not sure if that's exactly what you were looking for, but that's how I see the landscape today.
One more question? Right. Okay, one last question, right at the back.
Hi, my name is Manuel Tercero, JP Morgan. I'm in the fixed income area. I guess I'd like to build on Patrik's point. I think the model people in banks, they have a too bad reputation. And my point is that I think a lot of the models people, do have a lot of common sense. So it has been used. So I guess the question I have is, to what extent the source of a lot of the problems, the financial crisis, was the lack of resiliency in the system, in the sense that if just a relatively small proportion of people taking big trading decisions did not understand that our models could not be used without judgment, that relatively small percentage was able to take big decisions of risk, and then on the management side, it was the lack of understanding that those models sometimes produce results which could be misunderstood and misapplied. It's a combination of small people taking big positions and the management layer not being able to understand these dynamics, which led to losses which a few people generated, like in the billions. So I think it's that dynamic, as opposed to the 95% of people who understand what they're doing.
Right. Patrik,
Well,
would you agree?
I would just throw out the one thing that people, there's no question that there was some unanticipated interconnectivity and house of cards in a lot of areas and CDO squares, and the issues manifested themselves in a lot of ways. But I still believe that if you start with the fundamental building block that residential real estate in the United States fell by 35% at a national level, and in the the biggest states, it was more than 50%. I would just take one step back, and if you did a full survey with risk managers, regulators, bank CEOs, heads of markets, whoever, and said, this is the reasonable scenario that we should run our risk management to, I would argue that not a single one would have raised their hands. And at the end of the day, the issue is that I have no explanation for exactly how everything worked its way through the system, but I think sometimes people forget that the starting point was something very, very simple. And the real question around the prices has to be, what were the forces that led to that massive rise, which Andy showed in his graph around the spike in real estate prices. Because a lot of bells and whistles, a lot of unanticipated consequences, but I would argue that most of the net losses would follow directly from just running through that scenario of real estate prices, because no one believed that it was possible.
Well, Patrik, I would take slight issue with that and say that after working in Japan and writing my book about Japan, which I modeled on when Genius failed,
Yep.
I then went to America and had a lot of arguments with people in America in 2005 and 2006 when I discovered that there was no way to express house price falls, i.e. negative house price inflation, as the Fed used to call it, in their models, because everyone has such tunnel vision, they assumed that house prices would always go up, which from anyone from a Japanese background was completely nuts. Astonishing example of tunnel vision. And again, I'd say another reason why we need more anthropologists in finance, but talking my own book. But anyway, anyone want to make any final comment before we go for lunch?
I think one small statement, which is it does really at the end of the day have to do with the behavior of crowds, not just individuals, because quite often banks and other risk managers kind of look sideways and see what others are doing, and there's a fair amount of communication about that. And if somebody else is doing the same thing, they take heart from the fact that they're not doing something wrong. And that ends up with creating systemic positions within the industry. And then when there's a rock that comes off the top of the mountain, it creates an avalanche. The reaction of the regulators to that then, subsequently, ends up changing the rules of the game. Everybody thinks that there's a rule that you're going to play by. For example, in September 15th, 2008, everybody thought you were playing with the rule that said that it doesn't really matter whether you're Bear Stearns or Northern Rock, we're going to kind of save you. We're going to save the bondholders anyway. On September 15th, that rule changed. And it took $700 and something billion and a lot of hand-waving for the Fed and the regulators to come back and say, really, we didn't mean it. We are going to save you in the future. And the credibility had been destroyed. And that's what caused the freezing up of markets.
Exactly.
So you can't change rules. And that's, I think, at the end of the day, the point.
But what you can try and do is predict the rocks and dodge the rocks and make money off the back of the rocks. So I'll just finish by saying best of luck to all of you in trying to make money from those rocks. And thank you all very much indeed for a very frank and lively conversation. Thank you.
Thank you.